Good afternoon. My name is Marcus Noland. I'm the Director of Studies here at the Peterson Institute. If you could quickly grab your coffee and dessert and get back to your seats, we'd like to get started again. We have quite a full and impressive third panel on making the United States an attractive base for multinational corporations. We're going to start with two presentations by people who literally don't need any introduction because they've already been up here twice before during the morning. Ted Moran from our institute and Georgetown University will first discuss managing national security concerns, and he will be followed by Gary Huffbauer discussing tax competitiveness issues. Then we'll have two discussants. The first of these will be Mr. Craig Jones. He's Senior Managing Tax Counsel for Dow Chemical, has decades of experience as a tax lawyer. He's also Global Tax Director for Dow AgroSciences, which is a US-based multinational with R&D, manufacturing, and distribution operations throughout the world. And in that position, he is responsible for US and foreign tax planning, including transfer pricing, intellectual property ownership, and cross-border merger and acquisition activity. Then our final speaker on the panel is Dr. Robert J. Shapiro of Sonecon. He is probably well known to most, if not all of you here, as one of the founders of the Progressive Policy Institute, advisors to two U.S. presidents, service in the Commerce Department during the Clinton administration, and now a variety of additional affiliations, including also the Georgetown University School of Business. So let's get started. We'll have the four speakers, then we'll have question and answer period, and finally a little bit of time for them to give any final responses. So, no, just wait there. So, Ted.
Thank you very much. Well, in my time, I would like to do two distinct things. First of all, I want to try and persuade you that the three threats framework that you've already heard a little bit about can be generalizable and with great benefit to everybody throughout the OECD, but in fact could be generalizable to China, Russia. I mean, there's no reason why it couldn't be expanded beyond the OECD. That's my first argument. The second is then I want to get into some issues of cybersecurity and global supply chains in information technology. Okay, I have actually run this idea by some members of the investment committee in the OECD, and the three threats perspective that I already laid out complements and enhances the OECD goals of transparency of policies, predictability of outcomes, measures of general application which treat similarly situated investors in a similar fashion. That is the OECD framework. But the OECD guidelines say that essential security concerns are self-judging. So each country has a right to determine what's necessary to protect its own national security. Well, I want to limit the ability of countries to determine what's necessary to protect national security. I mean, by common agreement, I think we should move in that direction. Now, I have been advised by everybody with whom I've spoken not to put this slide up here because you will not be able to follow it. It is on page 71 of the book, but let me just tell you what it does. It is a flow chart, a decision tree that takes you step by step through the process of measuring criticalness, concentration, then also finding out whether or not it's plausible for there to be any one of the three threats that I described. So this is just a generalization, a step-by-step guide. Now, my argument is that if we follow this decision tree, it would impose a common discipline for all OECD members to evaluate whether concerns about a possible national security threat are plausible. In the language of the OECD, there is a lot of discussion, as there is in the United States, about essential industries. And that includes finance. So, you can exclude finance, you can exclude energy, and I want to go against that. I mean, I want to say that it does not make sense to exclude entire sectors. You have to look at the concentration and the plausibility of a genuine national security threat. Okay, that's exactly what I just said. Now, so this threat assessment tool deliberately discriminates as to when a particular proposed acquisition within a particular sector might pose a threat. Now, I have to tell Mike, this doesn't have reciprocity. This doesn't have national economic tests. This actually strips away some of these kinds of things. And I had several people come up and say I was way too wishy-washy. I should have pushed back harder. And so now I am officially pushing back and saying if I had my way at running the world, this is the way it would look. Okay, now the rest of my time, my short time, I want to talk about threat 3, surveillance or sabotage, and cybersecurity in an era of globalized IT supply chains. Many of you know, but all of you should know, that I serve on the International Advisory Committee of Huawei. So, and this is disclosed in my bio, it's disclosed on my webpage. I mean, I go out of my way to make sure people understand this. So be alert to whether or not you think there is special pleading or conflict of interest. I don't think so. I mean, I think what I'm going to propose is plausible, but then I would like Claude, I would like Mike, I mean, I would like other people to comment on whether or not they think my argument makes sense. So, intelligence agencies and congressional leaders in the United States have fixed on the idea that if you prohibit IT suppliers of certain nationalities from participating in national telecommunication networks, this will help you in the battle against threat 3, cybersecurity, intrusion, sabotage, backdoors, trapdoors, etc. Well, so I want to pose the independent question: does a policy of trying to protect by singling out companies by nationality likely to be effective? And from my own experience, if you travel through Shenzhen, the taxi takes you by Ericsson, Lucent, Alcatel, Samsung, Cisco, et cetera, et cetera. I mean, you have every single one of the suppliers of IT in China, and most of these companies outsource the manufacture of components to India, Israel, Russia, Taiwan, Malaysia, I mean, et cetera, et cetera. I'm only actually stating the obvious. It's just amazing how people say, well, the way to get at this supply chain problem is to forbid a particular nationality company from participating. So it seems to me, I propose, that the world needs an array of independent cybersecurity assessment cells around the globe. We have a couple of these, so we have some examples of how they vet the hardware and software of all the IT suppliers. Once you're vetting it, you can, I'm not an expert in computer science, but you can put a time date stamp so that you can tell if it has been fiddled with since the vetting process. This goes both hardware, software, and can apply to patches and upgrades too. So it seems to me that the only way to deal with threat 3, intrusion, sabotage, is to have some multilateral way of vetting for these kinds of trapdoors and backdoors. And it seems to me it's in the interest of buyers and suppliers everywhere to get this system in place that prevent the compromise of globalized supply chains without disrupting the flow of technology. Thank you.
Thanks, Mark, and thanks everybody who stayed after lunch. I'm sorry Jared had to leave because that would have led to a more interesting debate. To anyone who's spent some time in the tax code, you know, it's like the little boy with a hammer, everything looks like a nail. But I'm going at the end of this to try to talk about some issues of attractiveness that don't have anything to do or have little to do with the tax system. So if we talk about the tax code first, and this is spinning off our morning session, the U.S. really needs meaningful tax reform, and the statutory rate should be cut to 25% or lower. If we want to be on average competitive, it should be 20%. We need a competitive system with a low U.S. rate under 5% on repatriated foreign subsidiary earnings. And that's about what we collect under the present system, actually a little less than 5% when firms repatriate their earnings, as I said this morning. Possibly for revenue reasons, we should tax accumulated foreign earnings, past accumulated foreign earnings at a low rate, again, under 5%, and given that the number is about $2 trillion, you're talking about $100 billion, perhaps, that could be raised, but there should be no tax going forward. Get rid of the foreign tax credit on repatriated dividends. That's seems almost obvious. And this last bullet is an important one. We want to be the place where research and development is done. 85% was the number that Lindsay gave us for multinationals doing research around the world. 85% is here in the U.S. We should emulate the Dutch, no tax on royalty income from abroad. Of course, no foreign tax credit either, but no tax, so that this is really a great place to do research and get the royalty income from abroad, trademarks, royalties, copyrights, and so forth. Now, if we did this, our multinationals would be competing on a roughly level tax field with their foreign peers. And now I have a very brief analytic plug in case anybody from the Treasury is here or anybody from the U.S. government. They spend a lot of time analyzing U.S. taxation of U.S. multinationals. As far as I know, they spend no time analyzing foreign taxation of multinationals based even in OECD countries. And you can't do the analysis on the basis of the statutory codes. Ernst & Young and other firms do that, but that doesn't get you there. You need to get to the actual data on actual firms. U.S. can do that on its multinationals. What we need to do is have similar data for other, at least OECD firms, and hopefully firms based outside Brazil, India, so forth, so we can really see what the level playing field is now. Right now we have the statutory rates. They seem much to favor foreign multinationals. That could be analyzed to a greater extent. If we do these things I've talked about, we should get faster expansion of U.S. MNCs abroad, which I think for the complementary reasons is a good thing. We get more R&D at home, more employment, and so forth. And we have a greater incentive for R&D to be done here because we don't tax royalties coming back. And we get a simpler tax system if we can just very sharply cut back on the foreign tax credit. This is a huge source of employment for K Street, but we're on Massachusetts Avenue. I don't really care about employing K Street to a greater extent than it's already employed. Now, what else besides the tax system? Well, our infrastructure, those who follow this part of the U.S. economy know it is truly, it's just amazing. The last 20 years, we've gone downhill, downhill, downhill on infrastructure. Now, if Bill Frenzel would get to work and cut back on entitlements, which he's supposed to do for the last 20 years, we'd have public money to spend on infrastructure. We have no public money to spend on infrastructure. The states have spent it all on pension funds. You know what the federal government is doing. So what we need to do is reinvent the old user fee system that built the canals in this country and the railways and so forth and so on, and try to upgrade our infrastructure. That's both a state challenge and it's a federal challenge. Immigration, this is more federal. Everyone knows the immigration debate. Again, H-1B, you know, we're at 190,000 just a little more than a decade ago in terms of H-1B visas. We now managed to cut it back to 65. The current debate would maybe increase it. I don't know if they'd get back to 190, but they really should be shooting for 500,000 H-1B, that's skilled worker visas a year. And likewise with the L visas, I won't go into the details, but the L visas are rather restrictive compared to what other countries do. And then the final thing, which is familiar to everybody here, our colleague Jacob Kierkegaard wrote some good stuff on this. The fact of the matter is that as a nation, we're getting dumber relative to our peers, relative to Korea, relative to other countries. Our education is slipping, and you have some numbers there. This is a national problem, and it certainly is a problem for multinational corporations. Thank you.
Hello, I'm Craig Jones. I'm a tax lawyer at Dow Chemical. So I'm one person here who actually works in the tax department and applies the tax laws that we're talking about. Dow Chemical is an example of a U.S. multinational, probably that we have in mind. Dow was formed in the 1890s. It's one of the longest continuously operating U.S. companies. It was founded in Midland, Michigan, and our corporate headquarters are still there. We employ over 50,000 people globally. We operate in 37 countries. We have over 40 R&D locations around the world. We have over 200 manufacturing sites. We're a Fortune 50-ish company. And we expanded globally back in the 50s and 60s. And that's how Dow made its name around the world. And I imagine the executives who led that expansion would be surprised to hear that that's somehow controversial now from a U.S. policy standpoint. As far as tax reform goes, we are very involved in Washington on U.S. Corporate tax reform. We support a comprehensive reform of the U.S. corporate tax system, clearly broadening the base and having everything on the table from a revenue standpoint is what we support. A lower rate is critical to be more in line with other countries. We think the reform of the corporate system can be revenue neutral within itself. We're not proposing to pay for it by taxing flow-throughs or increasing tax on individuals. We also think that R&D is important. We've heard that over and over today. So a lower rate on the revenue down the road that's generated from R&D expenditures in the U.S. would go a long way to attracting R&D activity and the high-paying jobs that come with it. But I'll get back to this later. We agree with the complementary theory and that a reform of the system that lets us be more competitive globally with companies that are subject to the tax systems of our competitive companies is what will increase U.S. tax revenue and growth and employment in the U.S. And I have an example of how I think that works. Let me go over the practical aspects of what tax lawyers in a multinational think about. Just real basically, a multinational company operates largely through one legal entity in each country. So we have actually hundreds of legal entities, but we at least have one legal entity in each country, and the goal is for that legal entity to be subject to tax in only one country. Otherwise, you get two countries fighting over the same legal entity's income tax. So you want them to file one tax return in one country. So a lot of what goes on in a tax department is thinking about the way these companies interact with each other in the supply chain. So it doesn't surprise me at all that Lindsay cites that 80% of product flows happen intercompany among multinational corporation subsidiaries. And on the notion of tax planning versus tax avoidance, let me emphasize that the companies in a structure like Dow's these companies are under continuous audit. So the IRS has offices in our corporate headquarters in Midland on the same floor as our tax department. We are audited for every year, and it's pretty much the same in every other large country that we operate in. So nothing a multinational like us does flies under the radar screen. The fact that we operate so broadly in geographic terms is very important to us. It's helped our growth over the years, and diversity is very important. Our current CEO started 30 years ago at Dow Australia. So it's this diversity and our presence in these countries that lets us be competitive on a global level. So the idea that we could manufacture everything in the US and do all of our R&D here and export it and serve the world is not the case. I also would say that the tax department operating with these rules has limited ability to dictate where manufacturing happens or where R&D happens. I mean, tax rules should not make the U.S. uncompetitive or discourage things being located in the U.S., but there are so many other factors. Manufacturing is dictated by where demand is. We sell a lot of heavy chemicals. They're very bulky. We can't ship them from the U.S. The location of feedstocks are very important, shipping channels. There's just a whole array of business-driven factors that control where things get located. What the tax rules do, though, is affect the tax planning that happens once the supply chain largely gets set by business factors. And what tax lawyers do is control the interaction among the companies from a legal perspective. What are their rights? How do they contract with each other? What are their legal relationships? The transfer pricing that happens when product moves from one legal entity to the other has a big impact on where the profit gets located and what tax return it turns up on. So in a tax lawyer's toolbox are a lot of decisions to be made about where the parent company is located, what entity is issuing shares to the public. That may or may not be the same company that has the corporate headquarters. Where is R&D done? Well, that might not be the same legal entity. The R&D employees might not be employed by the same legal entity that is funding the R&D and owns the intellectual property. What entities are operating as manufacturers? Are they doing it for their own account, or are they doing it under contract? Which legal entities in the supply chain are entrepreneurs? Which ones bear the risk of loss of product, or of a product failing, or the market changing, or R&D not panning out? Well, legal entities that take risk should be the ones that get the reward. So that's what tax lawyers and tax auditors are looking at. Along with these legal relationships, tax departments have a big impact on the repatriation strategy. So the points that have been made about how the U.S. currently imposes a tax when cash is repatriated or earnings are repatriated to the U.S., that is driven and that tax is calculated by the tax department. And just as a basic point, so we're all on the same page, the U.S. right now imposes the full 35% tax on dividends that come back to the U.S., but we get a tax credit for foreign taxes that have been paid. And by the way, those dividends or earnings may have come up through 5 tiers of foreign subsidiaries, and we calculate all the different taxes that were paid and how those dividends flowed through the various tax rules of, say, Germany, Switzerland, the Netherlands, and then to the U.S. So it's a complex calculation, and I'm thankful for the job security. But I would say that we totally agree with the complementary nature, despite the fact that the tax department often can't say to a business, do R&D here or put a plant there. At Dow AgroSciences, the agricultural, chemical, and biotechnology business that I'm most closely associated with at Dow, we do a lot of our R&D in the U.S., predominantly in the U.S. And what we do is we have a pipeline that starts with discovery R&D that maybe looks at 1,000 ideas and boils it down to 5, and then they go into a pipeline as projects. Well, that whole timeline of R&D is maybe 7 years long. So we do the R&D in the U.S. to develop active ingredients for agricultural chemicals, or to develop a trait that involves modifying the DNA of a seed. But that investment is in the hundreds of millions of dollars, and that's driven by business cases that are developed from the ground up from our foreign subsidiaries about what they think they can sell of that product down the road in their country. So we're banking on being competitive in that foreign market to get the return that justifies the hundreds of millions of dollars we're spending on R&D now. So, Lindsay, that's an example of the complementary nature. We need the success overseas. And another point is that once we develop the active ingredient or the traits in the U.S., then it needs to be tested in the foreign country in order to get it registered and to make sure it works with that soil and the way farmers work there, and to get it registered. So that all happens through the pipeline, and it might not be in the same year. We might have a heavy investment of R&D early in the timeline, and then later the foreign subsidiaries do the work on the ground to make sure the technology works in the foreign country. But it's all tied together. We wouldn't make the investment up front if we couldn't be successful at the end. So that's all I have. Hopefully I can answer any other questions about how things work in practice.
We've heard a description really from the bottom up from Craig, and very enlightening. I'm going to give you kind of the opposite. I'm a very big picture guy. First, I want to congratulate the Institute and the authors for undertaking such extensive and rigorous studies of what is the defining feature of modern globalization, the transfers of new technologies and entire business organizations from one country to another. This is the defining feature in particular for developing countries, because foreign direct investment has become the single most powerful factor that drives the modernization process in the developing world, when complemented with domestic public investment in infrastructure and education. For the United States, foreign direct investment represents something less critical, less central to our development, but it represents a way of promoting growth and employment and incomes, and that makes it fully important. For China and Malaysia and Egypt and Bolivia, foreign direct investment is a matter fundamental to their very development. So
economists, recognizing the kind of central node that foreign direct investment represents today, and recognizing that multinational corporations have lots of choices about where to locate their FDI, have studied what goes into those choices. And of course, Craig is right, it is a business decision, but each of those elements is also bounded by certain risks. And it is the evaluation of those risks which can determine precisely where the FDI is located. The surveys, however, and the studies have almost all focused on location decisions with regard to developing countries, not with regard to developed countries, much less the world's most advanced economy. They actually begin not with the economic factors, these studies and surveys, but with political factors, which really are threshold questions for whether you locate FDI in a country. In particular, the stability of the regime, the enforcement and character of property rights and contract rights, how bankruptcies are handled, risks of expropriation, levels of violence and corruption, and most generally, does the rule of law prevail? Because if it doesn't, it's really virtually impossible to do business in a country. The same holds for the economic factors, which again are much more of a question for developing nations than for developed ones. The reliability of telecommunications and the electricity supply, and other working infrastructure. Obviously, input costs, labor, physical resources, energy, real estate, the supply and quality of skilled labor, both for hiring directly and for the services which the firm will need to hire in the country. And then there are the structural economic factors. And this begins to look more like something that might be in the mind of a foreign multinational when thinking about investing in the United States, in particular the size of the market, the stability of the currency, the regulatory environment, including more so for developing countries than for us, cost to conduct trade. We ought to recognize that the benefits, the reason to think about why we would want to make the United States an attractive place for foreign direct investment, for multinationals to operate, should apply equally to the operations of foreign multinationals in the United States and U.S. multinationals in the United States. After all, the great benefit of FDI to most of the rest of the world, of introducing modern technology and business methods, applies very little to the U.S. economy. U.S. firms can buy, lease, or license any advance developed anywhere in the world. It's not a factor in the course of our economic development. We are a factor in the course of other nations' economic development. The political criteria also are not particularly relevant generally for FDI coming into the United States. The reason is that the alternatives pass muster too. In citing FDI in the United States, the alternatives are not China, Poland, or Mexico. They're the UK, Japan, or Canada. In terms of political stability and all the other political criteria, contracts, bankruptcies, etc., there's really very little to choose between the United States and the alternatives for foreign multinationals contemplating foreign direct investments. The decision to undertake large-scale FDI in the United States is most driven by the size and the quality of our market. Beginning with heavy goods, which require a developed country's labor force and service networks like automobiles. But the main issue is that a company has to live inside a market to truly understand what drives it and what drives market share within that market. You cannot do that from outside. And I see Craig nodding yes, because he lives this. And the fact is we are the world's largest market for many products. And that means that foreign-based multinationals must participate in the U.S. economy. There are also special markets where having a U.S. presence is really virtually compulsory. Medical devices and pharmaceuticals are a good example of this. And the reason is that we're the only advanced country in the world that doesn't directly regulate prices for medical devices and pharmaceuticals. And the returns on pharmaceutical sales within the United States are higher than they are in any other advanced country. And that means that foreign pharmaceutical companies must establish a real presence here because they have to establish an ongoing relationship with the FDA in order to get approval for their products in a market which will account for a majority of their profits. This is also true of certain high-end software niches and internet enterprises which depend upon the extended U.S. research establishment, as well as on the both physical and cultural fact that the United States has many, many more first adopters than other societies. Americans, not only because there are more of us, but also more Americans are eager to be the first to try a new information product than Europeans. So you can get the information a lot faster and cheaper if you start your presence in the United States. And all of this, helps explain why we have more foreign direct investment than anybody else. It's not accidental. It comes out of the particular features of our market, just as where our multinationals cite FDI comes out of the particular economic and political features of the countries where they cite their FDI. It's the same thought process, it's just the factors are a little different. Now, I also want to comment on the role of taxes in this, so very ably analyzed by my old friend, Gary Huffpower. I'm not commenting on your age, I'm commenting on our age, Gary. Yes, the corporate tax rate matters, especially for US FDI and other countries, although deferral deals with much of the potential disadvantage the 35% rate would have in many foreign markets. And I've been, as many of you know, a long time defender of the deferral system given our worldwide tax system. But the truth is our worldwide market shares in industries for the most advanced products and services, those market shares which are very high, in not across the board, but in a majority of categories, suggest that with deferral, there may be less substantial effect on our competitiveness from the tax system than one might suppose. And I again recur to Craig's presentation in which the decision about where to site and how to operate the company is not set by tax policy. Tax policy comes in after it to say, okay, given your business decisions, now how do we minimize our tax burden? Is there evidence that our high corporate rate affects foreign FDI here? Well, for foreign companies operating in the United States, the pertinent issue is the entire tax burden, which constitutes a cost, not the marginal rate, corporate rate. From that perspective, our business taxes certainly would be seen as competitive. We collect less revenues from business as a share of GDP and as a share of business receipts than most other large advanced economies. Not all, but most. We have substantial payroll taxes as part of our labor costs, but payroll taxes are certainly higher in most European countries. There's no VAT here, though there is local and state sales taxes. the combined payroll, VAT, and corporate tax burden in the United States is still substantially lower than most other, certainly European, advanced economies. And again, that's the choice between us and other advanced economies when we're thinking about FDI. It's only a little lower if we also take into account healthcare costs, since the payroll taxes and VATs in many countries are used to finance national healthcare. This suggests that our tax system does not impose a competitive burden for FDI purposes compared to other places. Still, lower taxes are almost always better than higher taxes for businesses and certainly for overall economies. And that would apply to both U.S. and foreign-based firms operating in the United States. So the question is, how much lower is realistic and can be justified? We should continue, I think, to tax foreign and domestic profits at the same rate, so the tax code does not create an artificial incentive to either move operations abroad or forego FDI abroad. Now, there is lots of talk about the 25% rate, corporate rate, the average for OECD countries. But if the issue is relative competitiveness and FDI, then maybe we ought to consider the rate which is an average across all countries weighted for their share of the total stock of US FDI, on the assumption that there is a relationship between the profits being generated and the amount of investment you've done in that country. Well, I did that exercise. That is, I divided all of our FDI by stock of FDI, not flows, by the country in which it was located, and then I used that share to weight the particular corporate, just looking at the corporate tax rate in each country, and the average comes out to between 28 and 29%. We have a lot of FDI in countries with relatively higher tax rates, which is other advanced countries. Remember that 70% of our stock of FDI is in advanced countries. That makes we have the highest share by far of any advanced country of stock in developing countries, but it's still in the range of 30%. The fact is that non-corporate entities now account for a majority of U.S. business revenues, and they account for a majority of U.S. business profits. This is what's happened in part because 35% rate. Most of those entities, the profits are taxed at the owner's personal rate, unless it's carried interest, of course. A revenue-neutral reform that with a 28% top rate for all business-related income, which would include profits earned here or abroad once repatriated, in corporate and non-corporate forms, could be financed by it would require ending most corporate preferences, plus perhaps a new twist on the personal rates. Say 28% for all business and corporate income, and for capital income to finance the lower rate on non-corporate business income. And then the decision about the top rate on labor and other assorted income could be made depending on where the revenue calculations come out. It's pretty messy, I concede. But what are the alternatives without shifting more of the tax burden to middle-class households whose incomes have stagnated or lost ground for more than a decade? Thank you.
I have to admit, when Adam Posen sent me an email and asked me could I step in for Fred and chair this final session, I saw that we had 4 speakers and it was after lunch and it was on tax policy. And I have to admit, I thought this might be a bit of a slog. But we've had 4 very interesting presentations. We've covered a lot of ground, both the tax policy aspects, cybersecurity, and other things. So I think there's a very rich agenda for discussion, and I'd like to open up for questions. What we'll do is we'll take some questions. We'll let the panelists respond, and then at the very end, I'll give the panelists an opportunity for any final thoughts they have. Yes, Ernie Prieg. Please identify yourself and all of that. Well, one is on the way. There's also a mic behind you.
Ernie Prieg, Manufacturers Alliance. I'd like to raise a subject that hasn't been mentioned today, but I believe is an important dimension of FDI relationships, and that's exchange rates. And the basic question is, how important are exchange rates in terms of U.S. FDI and outsourcing of jobs, particularly for manufacturing and business services? A number of countries, China certainly, some other Asians, have been engaged in protracted large-scale official intervention in currency markets, which has the effect of having a much lower currency or exchange rate than a market-based rate, and that results in an across-the-board lowering of costs for FDI. So that leads me to two specific questions. First, just how important are exchange rates for attracting job-creating investment here, and also for attracting outsourcing of U.S. jobs to China and elsewhere? And the second question related to that is, if there is a significant adverse impact for U.S. jobs and U.S. There's also the trade deficit relationship, does this justify the recent proposal by a senior member of the Peterson Institute staff that the U.S. should declare a currency war on currency wars?
Interesting. Let's take a couple more questions, and then we can respond over here.
Thank you. Mike Delaney, Office of the U.S. Trade Representative. I have, this is probably directed to Ted. I have read your chart. I have worked my way through that. I'd like to present a case study of this that doesn't easily fit into your paradigm here. In Australia, they have a Foreign Investment Review Board, and they have a national interest criterion on this, which is thought to be broader than national security. Now, in the early maybe 2001, 2002, they were going through a review of Shell Oil's purchase of a large offshore oil block, and it would be purchased from an Australian entity. Now, it was a rather sophisticated analysis, which I believe to have some validity, and I'd be interested in your views on it. The argument doesn't easily fit into any of your three things. The argument was this, that Australia really wanted this field to be developed. They wanted to get the revenue from this field. Shell Oil, they had a lot of other properties, and there was a rather sophisticated analysis of how this property would fit into Shell's overall marketing. And the case was made that maybe Shell wouldn't be quite so forward-leaning in the trenches in developing this field as much as Woodside, which was the Australian entity. Yeah. So it was a competitiveness issue. It was developing the economy. The current management would more effectively market this thing, more aggressively market it, and if we turn it over to Shell, they would get caught in all sorts of corporate strategy, which might not put Australia first. So I'd be interested in your comment on that.
Great. Claude Barfield.
Claude Barfield again from AEI. I'm going to be blunt, so let me say, as Ted said, unlike Ted, I'm not a part of a Huawei advisory committee or anything to do with Huawei, and I come from an institute that is not known to be peopled by panda huggers. So let me talk a little bit about Ted's, he asked me to comment on his recommendation. The idea of having the centers such as you have in Britain and other countries, I think is a very good one. I have one caveat, however. When I did the study of Huawei for AEI a couple of years ago, and I had, as I suspect you did, I'm a trade guy, I had a crash course in the security side. But I came out of that with being struck by a comment of someone, and I think is still true today, is that these centers are very good, but that his point was that whether you're a corporation or a government, you've got now to assume the enemy is inside the gates. because the offense in terms of cybersecurity is so much ahead of defense. And so while I think that it's good that Huawei has done this in England and that there's pressure to do this now internationally, I still don't think it's going to solve all the problems. And one final set of comments, and forgive me, I wasn't here for the first hour this morning, so maybe somebody raised this, but I don't think in the United States, and in this particular conference, we can go forward without some comment about what has just occurred in terms of the NSA over the last 2 weeks. And I'm not talking about earlier stuff. I'm talking about the things that came out in terms of the criteria that we have used politically to exclude Huawei and ZTE from the US market in effect, which was that the Chinese government could intervene. If they hadn't intervened yet, they might intervene in the future to have malware or some trap doors or do something with software. Well, what we have seen in the last week and a half or 2 weeks is exactly what the NSA has been doing for some years successfully. They have pushed trap doors in terms of software. They have pressed to have standards that are weaker, international standards in terms of security that are weaker so that they could get into the systems. In other words, all of the things, or pretty much all of the things that were the criteria that we used for the Chinese companies, or something that our own government has actually been doing. I mean, it's going to be interesting to see when the U.S. TR and whoever else sits down with the Chinese next time and raises cybersecurity issues. What do they say? I should say finally that about a year ago, I don't know whether Nick Lardy is still here or not, because he knows something about this also. The House Intelligence Committee issued a report which said that the United States should not, U.S. companies should not participate either in terms of contracts or whatever with Huawei and ZTE, and the point that they raised was exactly the points that the NSA has now done. I'm not holding my breath, but it seems to me that it would be a good thing if the House Intelligence Committee issued a formal apology to those companies for this report. I should say that some of you probably know this if you follow it, that The Economist actually wrote this up about a year ago, and the point The Economist made was that this was a report, a disgraceful report, I should say, that was made for vegetarians because there was no meat in it. Thank you.
Well, we've had three very distinct set of questions. As someone who has had responsibility for a computer system here at the Peterson Institute, which has been repeatedly hacked and had all sorts of stuff done by people residing in China, and whose personal email account is monitored by people residing in China, I will forego any comment on Claude's concerns. But anyone want to address the specific comment directed to Ted on the National Security Clause in CFIUS, the cybersecurity issues, and Ernie's questions about exchange rates? Sure.
I don't have much to add on national security, but I have looked at the impact of exchange rates on FDI. With respect to FDI into the United States, exchange rates seem to affect the timing. That is, foreign companies look for a time when, having made the decision to establish an operation in the United States, look for a moment when it'll be relatively cheaper. And so it can affect the timing, or there is evidence that it affects the timing, but not the decision. With respect to to FDI into developing countries, what companies are looking for mainly is a relative lack of volatility in the exchange rate. So they can figure out what their expected costs and profits are going to be, because after all, this is, you set up an operation in one country, but it's part of a long supply chain with things going to and from lots of other countries. And eventually the profits coming back to the United States if it's a U.S. multinational. And so they look for a lack of volatility. The volatility, of course, is related to other factors, to other governance factors, which create volatility. A disposition towards sovereign debt defaults like Argentina, or inflation, regular problems with inflation which exceed those in similar markets, or it may come from capital controls. So usually when you see the volatility, what you're seeing is a symptom of other issues which would also come up in a risk analysis for a large-scale foreign direct investment.
Anybody want to add anything?
Ernie also asked the question about the currency war, and our two currency warriors, two foremost, Fred and Joe Gagnon, are not here, so they really can't speak to that. But the complaint of the currency warriors is much more focused on the trade account than the FDI account. In fact, I haven't heard them at all speak to the FDI either inward or outward in relation to the currency manipulation question to which you referred, Ernie. The only other thing I would add is that I'll take this up privately with Rob Shapiro. I thought he was too complacent about the U.S. tax position, given the new competition from other countries, not the traditional countries, but other countries. And I don't know if he referenced in his calculations VAT, but the U.S. is the only major country which does not have a national consumption tax. And these are, of course, adjusted at the border, which I would argue over time gives an advantage to the country with that kind of tax system as opposed to the kind of tax system that we have.
But a VAT isn't a tax on a corporation.
Right,
Okay. It's passed through to the consumer.
right.
Okay.
Right. It's a cost factor within that market. Right.
Just as a sales tax is.
Right. Although we should recognize, and it's kind of interesting, that VAT sales taxes are not fully passed on. They are, on average, passed on at about 69 to 75%, depending on the market. It depends on the competitiveness of the particular market, which allows you to pass on a greater or lesser extent of these taxes.
But I'm just highlighting that a VAT, by its structure, gets pushed through the system
Yes.
and is borne
Yeah.
by the consumer in the
Right.
same way a sales tax is.
Right.
Just arguably, a VAT gets collected and refunded, 5 times through the chain of moving from different companies, whereas the sales tax just gets imposed once
Right.
and is arguably more efficient in that sense.
Right. But more politically visible.
Yes.
Any more comments on this group of questions? Okay, Bob Vestine.
Well, angels rush in where fools fear to tread. I mean, fools rush in where angels fear to tread, according to Mr. Pepys. Anyway, I'm still smarting from the Mike Wessel's presentation. We've established that U.S. has the most stake in FDI, inward and outward. We've established its benefits to U.S. employment, U.S. R&D, the other factors that Lindsay mentioned. We've established that China is a very small investor in the United States. What we haven't established exactly is that the U.S. is engaged right now in a negotiation in the Trans-Pacific Partnership with 11 other countries, including Canada, Mexico, Australia, blah, blah, Borneo, and Vietnam and Malaysia, to establish the rule of national treatment for U.S. foreign direct investment in those markets. Now, some of them honor it already, but look, Canada, it's got an investment an equity control on U.S. financial institutions of 30% or something. It's got a requirement that only a certain share of U.S. direct investments in the financial sector can be fully owned by foreigners. Obviously, they're scared still of the U.S. and others, I suppose. So anyway, we're engaged in this constant effort all around the world, in the GATS, in the Trade and International Services Agreement, I suspect in the Transatlantic Trade Partnership, though that's probably not so relevant here, to establish the rule of law that as a rule of law, that U.S. companies get treated the same as foreign ones. So how in the world can we anybody justify, given that set of facts, expanding the CFIUS beyond its national security role to review greenfield investments that have nothing to do, or even acquisitions that have nothing to do with national security, and then move on into contracts? It just seems impossible. Or to try to attempt to impose a rule of national benefit. This is something we're fighting right now with the Malaysians, trying to get them to move off the national benefit rule. So in that context, maybe there's more comment from the panel. Does Mr. Moran have further views on his earlier position?
Do we have any other questions? Yes, one back here.
Thank you. Danny Xufengjiang with Xinhua News Agency. I want to ask about the tax reform. Nowadays, with the politicians in this town stuck in short-term issues like annual budget and the debt ceiling, when would be the possible time window for a tax reform? And should we combine the corporate tax reform and individual tax reform together? Secondly, recently there are some discussions on the growing wealth gap in this country. So when we are moving over the next round of a tax reform, how can we make sure the wealth gap would be reduced? Should we increase the capital gains rates? Should we do something else? Thank you.
Very good question. More questions? Well, if there's no more questions, let's turn to the two questions we have on the table. First, Ted, why don't you respond to Bob?
I'm not going to respond to, oh, there you are. He shamed me at lunch. And now he shamed me in front of the entire audience. So I'm primed to back down from any possibility of a national interest test.
Well, I was hoping to expand the idea of Wessel beyond that particular point. So I apologize.
No. I'm taking this lightly, and I'm buying your argument. And the extra thing of getting the government involved in reviewing purchase agreements and contracts, I just think is, off the wall.
Well, I'll leap into the tax question, but I want to point out that we have Bill Frenzel here, who's an extremely astute observer of congressional matters, and especially in the tax and expenditure field. So the first point is that the opportunity for tax reform is not great because it's so tied in with the budget deficit issue. And the budget deficit and the continuing resolution and so forth may occupy all the energy that Congress has on this kind of general file, especially given the resistance of the administration to put entitlements on the table in a meaningful way, and the resistance of the House Republicans to consider additional tax revenue. So there's very strong resistance to any kind of big bargain. That would be point one. So the related points, which I think are important, are these. I hear what you say about the median income and that issue, which has been very much in the debate. to the extent taxes are part of the story or part of the cure, I think it's the personal tax, as I said earlier, and not business taxation. Next point would be on the boxes of reform if we had reform. It's very difficult to, and I think probably politically impossible, to take higher taxes on individuals and put them into corporate reform. But it's not necessary if we could just get Gary Robbins and Steve Enton and some other people into the CBO and do correct analysis of what corporate reform would mean in terms of revenues. It's not negative. And we have a table in our book, if you have a chance to look at it, which shows what OECD countries have done over the last 30 years in terms of reducing rates and what it means for corporate revenue as a percent of GDP, and what it means is this: zero. Rates have come down, corporate revenue as a percent of GDP has not come down, and that's because you get an automatic base broadening. But that's not how we score it. So the way it's scored is a real enemy in this country of any of the kinds of corporate reform that I've talked about. One very final point, and I'm picking up on what Craig very softly alluded to. He did not want to do corporate reform on the back of, I think he called, I don't know if you used the word pass-through, I think Craig had used another term, but all these entities, there are about 6 or 7 in the code, which are not taxed at the business level. And as somebody pointed out, they're more than half of business revenue, business profits, and so forth in this country. And Senator Hatch, who is not known for wanting to increase taxes, I've heard him on this subject, he says, we're not going to do corporate reform by throwing the little guys under the bus. That's his phrase. So he doesn't want to do anything about the REITs, the LLPs, the LLCs, and so forth, and so on. And he probably has a much better judgment of the political possibilities than I do. But I would say at least you could stop. Possibly you could stop the expansion of this realm of pass-throughs, because the expansion of that means that, what you're going to do is end up with a corporate tax on my neighbor to my left and your right.
Yep. I mean, just to be clear, Dow Chemical thinks that we can go a very long way in reforming the corporate tax code, just looking at corporate taxes, broadening the base, lowering the rate, and for sure some aspect of dynamic scoring would make that much easier to be revenue neutral and to achieve as low a rate as possible.
Okay, well, if there are no more questions, what I'd like to do is give each of the speakers, and we'll just work our way down the line, a minute. Well, we do have a question.
Hi, Steve Enton with the Tax Foundation. Gary, thank you for the references. To what extent is it possible for the government to redistribute wealth by raising taxes on capital at some point on some individuals without destroying the wealth and negating the effect? And to get it down to this more or less class warfare issue, to what extent do the benefits of foreign direct investment into the United States and capital formation here lift wages and spread the benefits to the rest of the population?
Good question, Steve, but I think they're fodder for another book.
Okay, Rob, do you have any final comments?
I've already said that from an economic point of view, I think it is very desirable that we approach the corporate tax reform in terms of the reform of the taxation of business income rather than simply the corporate form. That doesn't mean you can't make progress if you look, when we get half a loaf in Washington, that's a feast. So I wouldn't say that, I certainly wouldn't oppose a corporate reform that did nothing about business income. other forms of business income. However, you will have a much, by definition, you will have a much weaker economic effect because you're affecting less than half of the business economy. That's the reason to approach it in a broader way, even though it's more difficult.
I hope I can dispel any possible misinterpretation. I spent much of my time talking about 3 threats, but please recall that the purpose was to show how rare are credible threats, so that in fact, I think rigorous application of the 3-threat formula, and hopefully across more than just the United States, would mean that most foreign investment anywhere in the world would be welcomed and could be shown to pose no plausible threat to national security whatsoever. So that was the thrust of my argument. Let me add one thing that Lindsay and I point out in the Inward Investment book. We tried to calculate, that hasn't come up yet explicitly, we tried to calculate what would be the expected level of Chinese investment in the United States. And Lindsay did say it is currently very small, but the extension of that is we would expect, just on the basis of the economic characteristics of the country, that Chinese investment across the board in the United States over the next, let's say, decade or decade and a half is going to expand very rapidly. Now, again, remember, we found out that they pay high wages, they conduct lots of R&D, so this, in general, would be very beneficial. But I think if we invited our colleague Dan Rosen here, we could tell him, you're going to be doing lots of business, Dan, because the expansion of Chinese investment in the United States over the next 10 years is going to be very high.
I would just echo everyone's comments that a lower tax rate is the way to go, even if the reform is revenue neutral to get there, because marginal rates do matter, and as much as the tax department doesn't drive many location decisions, a higher tax rate in the U.S. versus other places certainly drives things to happen outside the U.S. to the extent it makes sense with the business model.
Nope.
All right. Well, thank you all very much for your participation. I'd like to especially thank Rob and Craig for spending their time with us. And, of course, Ted, Lindsay, and Gary for giving us such a bounty to consider this morning and this afternoon. So I guess we get a few minutes off for good behavior. Let's give all of our participants a big hand, and I declare this meeting adjourned. Thank you.